Hi everybody. Hello and welcome to the LSE. My name's Kate Hyam and I'm a policy fellow here at the Grantham Research Institute at LSE. And at Grantham, we are really delighted to be able to partner with legal voices of the future to support them in delivering these knowledge sessions. And we're delighted to see so many of you this evening. My job here is incredibly easy. I'm just here to say welcome to the building. If there is a fire alarm, it's not a drill. Please take the stairs down. There's water in a kitchen over there. There's bathrooms by both sets of lifts. Other than that, I think you're pretty much in safe hands. I'm really excited about the topic of this evening's session. This is a subject close to my own heart and my own research. But I'm going to hand over to Kat from LVF, who will tell you more about it. Thanks again.
Thanks, hopefully you can all hear me. Thank you very much to the Grantham Research Institute for hosting us again and for the partnership with them. So I'm Katrina Campbell, I'm one of the stewardship committee members of LVF, and I'm also an associate by the team. I don't know how many of you have here for the first time, but it's a new basis. So just to explain what LVF is, we are an organisation set up to try and encourage discourse and learning on the climate and ecological crises. So we interact with kind of junior lawyers, practitioners, and people who are interested in climate law. And part of what we do is hosting a monthly knowledge session. So this month's session is on climate change and risk. And it is going to be start off with a presentation by my colleague Lucia, and we shall introduce herself as well. But that presentation is going to last about 20 minutes, and there'll be some time for questions. So if anyone in the room has questions, you can ask them. I'll also, for everyone joining us online, if you just put questions in the chat, we'll be monitoring them. And then following that, which is going to be a panel event with about 3 speakers, so she'll introduce as well. And that will last about 45 minutes, and then we're going to take a break after that, just for a few minutes so you can stretch your legs and bathroom, get some water. And then after that, we're going to be having some creative content. So we're going to be watching a video, which Lucia will introduce a bit more detail, and we'll kind of break out into groups so that we can talk about the creative content. So I would definitely encourage you to stay for that, because it's a great time for us to kind of chat and get to know each other. But if you do have to leave at any point, we're not barricading you to this, or you can leave. So yeah, I'm going to hand over to Lucia, and we'll start with the presentation. Oh, sorry, just sorry, one final thing is that we are there's a pub booked afterwards. We've got all more one and Hopeburn booked afterwards. So that's to stand around and get to know some other people and casual environment. Then please do join us. Over to Lucia. Thank you.
The little red button.
I'll just press down for now. Yeah, it's on. Is that on? On. Turn it off. Okay, great. Thank you so much. And thank you everyone for coming out this evening. I am Lucia Williams, Senior Associate at Clyde & Co, where I specialize in climate risk and liability and dispute resolution, especially the international arbitration of insurance disputes. And I'm really delighted to be here tonight, especially the Grantham Research Institute, because it is one of the top centers worldwide for the study of climate policy and law, and it's really a privilege to be hosted by them. And this evening I'm going to talk about climate change and risk and the critical role that the insurance sector can play in the climate crisis. But first of all, well, Legal Voices, Kat has already very kindly introduced this really fantastic initiative. And before we kick off, just a show of hands, is there any insurance lawyers in the room or insurance practitioners? You scattered about, yeah, and I know there's some online. So welcome. I hope you might be familiar with some of the content already, but hopefully it'll still be interesting. Instead, who has actually bought insurance or made insurance claims ever? Show of hands. Yep.
pretty much everyone, I would say, which is very much reflective of the size and pretty ubiquitous nature of the insurance industry and why it's worth really talking about it in the context of climate risk.
Sorry, should I hold your microphone?
Am I hearing?
No, I think it's just people online are having a bit of difficulty hearing.
Oh, okay.
Okay. I think so, sorry, I think
I can use this one if it's better.
yeah, which
Is
is
it better?
maybe,
Yeah.
no, we'll just find out.
That's fine.
Oh,
sorry.
I'm so sorry, everyone, we're just having a mini
Tech
issues as
I'll
usual.
sort it out.
Yes. Okay. This is our laptop. We will share the slides now. Okay, so hopefully everyone online can see the slides. So, in a moment. Screen. Can you also hear me online if I speak into this microphone? I'm just gonna do it, sorry, everyone, just a quick sound check. Okay, so, yeah, going back to the insurance industry. It's valued about $6 trillion in revenue a couple of years ago. It's probably more than that by now, and it obviously plays a huge role in the global economy. And yeah, and in many cases, it's also mandatory to have insurance. So while it's not mandatory, for instance, to have a bank account and you can keep your money under your mattress if you wish, it is mandatory to have insurance in a lot of cases to carry out activities anywhere from driving a car to having certain jobs. And it's this risk that insurance is particularly suited to tackle. Especially the insurance industry has the threefold role, really, which it can play in the climate crisis. As firstly, a hub of knowledge, skills, and capabilities about the assessment of risk and the analysis of it. Secondly, as an enabler of the transfer, abatement, and mitigation of risk. And thirdly, as a key institutional investor globally. So insurance is about risk, and as long as there has been risk, there pretty much has been insurance. A lot of you will be familiar with the picture on your left there. Anyone? Don't be shy. It's the Code of Hammurabi. So it's one of the oldest examples of a written contract, which included a form of insurance known as bottom reinsurance. And it was where merchants took out a loan to cover a shipping expedition, but they lost their cargo at sea. They weren't expected to then repay the whole thing. The idea being that the interest paid on the loan would cover the risk of that loss. And insurance developed through the centuries. Other ancient examples are like burial clubs in ancient Rome, where soldiers would pitch in certain amounts to cover each other's funerals should they die in battle. And it really has evolved that pace with society developing with new technology. Fast forward a couple thousand years, building on your right, that one you will recognize. It is Lloyd's of London, which is arguably really at the heart of the worldwide insurance market. And as many of you will know, was founded in the 17th century as a coffee house by Edward Lloyd, who gathered information about risks affecting the shipping industry, pirates operating, storms coming. And he provided this information to his patrons, merchants, underwriters, and bankers. And it was really this activity of gathering information on risks and collecting them, knowing more about them, and using the technology available to analyze them that has enabled, in a large part, the insurance industry to thrive. And tonight we're very much here to talk about one of the main risks, obviously, facing society and the economy at the moment, which is climate risk. So this smiling gentleman is Mark Carney, former governor of the Bank of England.
who in 2015, just a few months before the Paris Agreement was entered into, gave a speech, a seminal speech to Lloyd's of London, which was meant to be a clarion call to the industry on the need to take action on climate change. He recognized that societies face profound environmental and social changes, and that with better information as a foundation, we can build a virtuous circle for understanding tomorrow's risks, better pricing for investors, better decisions by policymakers, and a smoother transition to a low carbon economy. So by building on the mantra that you can't manage what you can't measure, he went a step forward and said by managing what gets measured, we can break the tragedy of the horizon, which is what he saw as being climate change. In his speech, Mr. Carney set out 3 different types of risks, which have also been gone to form the basis of categorization of risks going forward. These being physical, transition, and liability risks. Physical risks being the more obvious and tangible risks of climate change in terms of heightened temperatures and causing increased floods, fires, tropical storms, and also which give rise to an increased protection gap between those areas that can be covered by insurance and those that can't, and the creation of so-called insurance deserts, areas where insurers will not cover risks. For instance, a lot of some parts of California now, insurers are pulling out of because it's just not possible to insure for this the scale of heightened fire risk in these places, leaving people to either move out or lose everything. Transition risks. Those are very much the financial risks involved in the transition to a net zero economy. So mainly stranded assets, being such things as oil fields, coal mines that are being funded now and insured, and that will become obsolete as the urgency to move away from fossil fuels becomes ever more prominent. And thirdly, liability risks. And these are the risks that governments and companies, especially large emitters around the world, face of being sued for their contribution to climate change and the effects of it, and also greenwashing risks. So companies misrepresenting the steps that they're taking in order to promote sustainability. And if you're interested in climate mitigation, I must recommend the Grantham Institute resources and reports, as well as the Data Center database that are really fantastic resources on this information. Mitigation that has really increased a lot in the past decade. So what can insurance do to tackle these risks? And I think we need to go back to thinking about what the key purpose of insurance was originally, which was to look down the line, assess dangers, and then spread the risk, try to pool resources to make them more manageable, and so that not one single individual or company would then be faced with covering disproportionate losses, and that protection is very much what policyholders pay for as well. And this crucial role of insurance in spreading risk has been recognized by the United Nations, which see it as a part of achieving sustainable development goals. And the insurance industry plays its part in many ways. For instance, the Insurance Development Forum is a great organization that brings together large insurers to aim to mitigate the risks of especially of disasters to climate vulnerable populations. And there's been research to show that just a 1% increase in insurance penetration in a territory can lead to up to around 22% decrease in the burden on the public purse of responding to these disasters. And as well, there's also the factor of how quickly disaster funding can get to affected areas, which is also an idea behind pre-need disaster financing. So obviously, the quicker that insurance can pay out and allow businesses to reopen and hospitals and schools and things to be rebuilt, then obviously the lesser is the toll on the economy. The Insurance Development Forum also works, for instance, with the Global Risk Modeling Alliance, which works around the world in countries from Nigeria to Costa Rica to help local authorities better model and prepare for risk, using systems such as catastrophe modeling, based on data, also known as cat modeling, but nothing to do with the feline, despite what comes up if you try and Google cat models. So moving to other ways that insurance can help, for instance, parametric insurance is a fairly new product, about maybe a decade or so it's been talked about. And it's a type of insurance which aims to address the kind of lag between disaster happening and payout. So in some traditional indemnity-based insurance, a policy would be underwritten, a broker would help sell it, and catastrophic event occurs, then there's a whole process of assessing the damage, policyholder claim, insurance submits the claim, adjuster sometimes gets involved, and then ultimately, once the damage is set, the policy would pay out. And that can take some time. So what parametric insurance does, using satellite data, heat sensors, and so on, is to aim to make the payouts immediate on a certain criteria coming into being. So, for instance, if you have a field of crops and have drought conditions, sensors would pick this up and trigger a policy which would pay out before the damage has actually occurred. So the policyholder would be able to put measures into place to try and prevent it, invest more in irrigation or take steps to alleviate that damage. Another way insurance can help is through wording. So the Lloyd's Market Association does some great work on this. They published a little while ago a clause on illegal and unreported and unregulated fishing to withdraw coverage from vessels engaging in this type of activity. And then associations like the Ocean Risk and Resilience Action Alliance.
Не fatigué, ma chérie. Oh, tu veux jouer de dodo?
I don't know if that comment was me, but I appreciate. Yes, I'm so sorry. The person on the iPad, could you please speak? I don't have the iPad either. Thank you. Back to the functioning of parametric insurance. Yeah, no, so to have illegal and unreported fishing happening, so that again they can provide this information and data to insurers. Okay, great. Okay, cool. Thank you. Sorry, I need to make you get up to press the buttons. Yeah, so other types of wording are exclusions. Again, this is part of the London Market Association. And this is a climate change exclusion, and it's meant to incentivize insurers, incentivize policyholders for engaging a certain type of activity that causes or contributes to climate change. So much as we've seen throughout insurance history, insurance has worked with policyholders and regulators to alleviate risks. For instance, after there have been great fires in London and Chicago and San Francisco, we saw insurance taking action to improve fire safety overall and fire hydrants and so on. So this is kind of a duplicate type of role that it can have. And insurance, we've seen a lot of sort of bodies coming together and cooperating on things. And this is another slide for fans of acronyms. And it's really just to give you a flavor of all of the sort of different bodies that are operating in the insurance space to try and work on issues surrounding the climate crisis. So I'm not going to talk about every single one of them, but we've got the International Association of Insurance Supervisors, Prudential Authority, UNEP, IOPA, and these are all kind of bodies that are making an effort, particularly in the as relates to insurers as investors as well, because that's the third and important role that insurance can have in the transition. There's about, I think, $40 trillion of assets under management worldwide that insurers hold, and about 1.7 billion just in London. And for those of you who were at the climate finance session last month, might be aware, and those of you who weren't as well, that there is a huge financing gap in terms of green financing. So insurers have a lot to contribute in that space as well. And it's not without obstacles. We've seen associations like the Net Zero Insurers Alliance come under criticism for being seen to promote collusion among insurers and insurers on the issue of disinvest or de-insuring fossil fuels. But their efforts have looked to replace that, and things are constantly changing. So how can lawyers help? What's inspired a generation of in many ways. So firstly, a lot of insurers will be your clients. So about 60% of client base is insurers, and so as trusted advisors, helping in reviewing policy wordings, helping with providing training, reviewing also like a lot of claims functions and dispute resolution are bread and butter of insurance lawyers, as some of you will know, and just being general overall know-it-alls about risks that might come up and affect our clients. Another way, and I'd be remiss not to mention great initiatives like the Chancery Lane Project, which provides and works together with industry practitioners to come up with contractual clauses. And I've put here some of the example of insurance clauses that aim to address specifically climate risk. And I've also included Paula's clause because I helped draft that, and Paula's my cousin. It's a clause that is meant to kind of encourage a circular economy by promoting repair and refurbishment instead of replacement with new products in insurance claims. So really, just to conclude, given the size of the challenge, there is definitely space for everyone to act, to get involved, raise awareness, and especially work with our clients to tackle this issue. It's very much a situation where all hands need to be on deck. And with that said, unless anyone has Any burning questions? Good, because I was gonna hand over to a fantastic panel now. I've given myself a very hard act to proceed here because we have Dr. Francisca Arnold-Dwyer, who literally wrote the book about insurance and climate change and law. So delighted that you could join us here this evening. Julie Luanco, who's an associate director in climate and nature liability team at Howden. Oh, and yeah, but just reminded me, I meant to say, I think it was CEO of Howden, who said insurance is the ultimate community product.
The CEO of Climate Risk and Resilience.
Okay, thank you. Thank you for the correction. And the insurance being the also global climate, global community product. So I really like that term and phrase. So thank you very much for coming and being here. And Melanie Martin of Carbon Insure Kita. And I'm delighted to say in fighting for colleagues as well. So without further ado, I'll pass over to them. And the first thing I was going to do is just to ask you to introduce yourselves and give us a little bit of background and what sort of drew you to the world of insurance.
Okay, well, shall I make a start? So I'm Francisca Arnold-Dwyer. I'm a senior lecturer in insurance law at Queen Mary University of London. And how did I get into insurance? Well, it was a blind date, but love at first sight. So before I went back into academia, I was a lawyer, an insurance lawyer, took a chance. And on my first year of my training contract, I pitched up in a nice suit and shiny shoes. And they said, you're going to be in our insurance team. So I spent 6 months in corporate insurance. I really liked it, and I liked it so much that I sort of manufactured that my other seats were also insurance related in litigation and in pensions. And then I qualified into insurance, and I was there for 10 years. And then I sort of decided to have a career change. I went back to academia, did a master's in commercial law and a PhD in commercial law. And since then, I've been teaching and researching in insurance law, and I teach the whole breadth of insurance subjects of insurance contract, insurance regulation, marine insurance law, and also reinsurance law. So that's me. Pass it on to you, Julie.
Hi, everyone. I'm Julie Wanko. I'm an associate director at Howden, team specifically in the climate and nature-related liability team. So Howden is one of the biggest insurance brokers in the world, and there's 15,000 employees. So there's $38 billion of premium under management. So to answer your question, what drew me to the insurance world? So I have a legal background. I worked in publishing, and then I worked at the Commonwealth Climate and Law Initiative, the CCLI. And I would say what drew me to insurance is it's an innovative tool, I think, to deal with climate change and biodiversity loss. So yeah, that's how I ended up in insurance. Passing over to Melanie.
Hi everyone, it's great to be here. Melanie, I'm head of legal at Kita. Kita is the carbon insurance specialist based at Lloyd's of London. We develop bespoke insurance products that safeguard the quality and performance of carbon transactions. And by reducing the risks involved in these projects, carbon insurance helps to channel more investment into carbon sequestration projects, thus enabling them to scale at the pace that we need to reach our global temperature targets. Just a bit of background on Kita. We're a young company. We were founded in December 2021. 3 co-founders who met at Carbon 13, a climate accelerator program based in Cambridge. We sit within, so we're backed by 3 Lloyd's syndicates, Chaucer, Munich Re, and Renaissance Re. And what drew, I've been at Kita for almost 2 years now. And But prior to joining Kita, I did an LLM in environmental law and policy, and before that, I was an associate at Clyde & Co. in the international arbitration team, where I worked on large subrogated insurance arbitration cases. But my relationship with insurance actually began before Clyde's. When I first started out my career, when I was 20 on my year abroad, I spent 6 months working at a firm of loss adjusters in Santiago, Chile. And it was during that time that an 8.2 magnitude earthquake hit northern Chile and caused a tsunami and lots of aftershocks. And we started processing the insurance claims that came from the households and businesses that were badly damaged. And it was there that I really grew to appreciate the role of insurance, the role that it has to play as providing financial protection and a sense of security to individuals and businesses against unexpected events. And then, fast forward a decade or so later at Kita, I'm even more fascinated by insurance now because I'm not working on the claims processing side, but on innovation. And we're working with insurers to develop new products for new types of risks to drive positive climate action. So it's been a real pleasure to work at Kita, and also just to be here and showcase a side of the insurance industry that you might not have come across before, that isn't really talked about. So thank you.
That's amazing. Thank you so much. Really, we've got such different kind of career paths and insights.
Sorry,
Yeah, could you just make sure, I know it's a bit ungainly, but
Yeah.
the viewers online, if you could speak either a bit closer to the microphone. Yeah. They are on,
Yeah.
yes.
Cool.
Yeah, thanks. Yeah, you've got such a really big kind of range of careers and experiences. And so I think I might start with you, Francisco, because you've just written this book. So would you tell us a bit about it?
Yeah, so how did I come to write the book? So it was about in 2019 when I was looking for a new research project. And at the time, there were a lot of regulatory communications about the impact, the financial impact of climate risks on an insurer's balance sheet. And I read it with great interest, and but somehow there was something nagging in me that sort of told me, there's something missing here. And what I then found out was missing, and at that point I couldn't really sort of verbalize it or formulate it, was that idea of what is now known as double materiality. So not just looking at the impact of climate change on the insurance company, but also what impacts the insurance company can have on the environment in a positive and in a negative sense. And that really sort of made me sort of look into the area, and I found that there was a lot of research already on green investment, green finance, but there was almost nothing on green insurance. And so I found sort of a nice research gap, and I got really into it. But it took me, well, so with COVID, it took me 3 years to produce the book, because the more I read, the more angles I discovered to it. And it's also one of these areas where constantly there are new papers and new things happening, and new policy papers and new regulatory papers. So even as I was writing, I was updating it. So what I ended up producing is, well, first of all, it has a function a bit like a textbook, an introduction to either an insurance lawyer, an insurance practitioner, or perhaps somebody operating in the climate or natural catastrophe space, but somebody who doesn't necessarily know how these areas of insurance and climate change and the law come together. So in that sense, I'm trying to sort of map out the legal and regulatory landscape in that area where insurance intersects with climate change. But also coming back to my sort of research gap moment, I really sort of started thinking about, like, Lucia, how you explained, well, what insurers contribute, and like you, I sort of settled on this idea of an enabling role. So it's not just about insurers being a sort of risk carrier of climate risk, and as you mentioned, increasingly that's becoming difficult because natural catastrophes just occur so often and so frequent with such severity that insurers are sort of stepping back or can only offer insurance at prices that people can't afford. So we have protection gaps. So there's sort of this risk transfer side, but I also wanted to sort of to think about what I've called sort of impact underwriting, where insurance products are used for supporting the energy transition. So this is insurance products that support new technologies and green infrastructure projects, because what you can achieve with having insurance cover is that you sort of de-risk the project, so the costs of financing become less, so it becomes more feasible. And insurance for infrastructures is they're well-known products. You've got the building or erection phase, where you've got products like construction or risk insurance. And then you've got the operational phase, where you have operational insurances. And so how can we expand these products to cover green projects and technologies? And also I think this is where the Europe products coming in, basically de-risking decarbonization. So that's one aspect. And then another aspect I was really interested in, and this overlaps with the clauses that you've mentioned, is how we can use existing insurance products, but make them so that they can support policyholders, so consumers and businesses, in their transition to a net zero economy. And it's well known that insurance can have this quasi-regulatory or governance effect, but this can also be sometimes quite harsh. So if you think about terms like warranties or exclusions, which are quite severe measures of forcing certain behaviors. So I also wanted to think about policy terms that don't penalize but incentivize policyholders to towards good behaviors. And for economists, these are also called nudge terms. And so I'm really interested in how we can use policy wordings to do that. But also not just policy wordings, also in the claims space. You mentioned repairs. There's a lot of talk about build back better. Insurers don't like this term, because there's a legal idea of that if your claim is better than what you had before, called betterment, you're giving something better. Insurers don't like that, because they think they have to pay more, so they prefer to call it build back more resiliently or something. And so I'm also really interested in how that claims element can be linked up to planning and building policies, but also how, for example, subrogation, by way of subrogation, subsidies and grants could be utilized to flow into that claims process. And then also, as you mentioned here, the investment side, insurers are enormous investors. They have big pots of money that are either invested long term in life insurance or on short term in general insurance. And there's huge potential of in investing in green projects and infrastructure. But there's also a lot of scope for combining insurance risk investment activities through capital structures. So there's a lot I'm covering in my book. And also, of course, there are a lot of unanswered questions. So I'm always interested to hear from people from the industry, from other lawyers, and also from people outside insurance, to develop solutions in those spaces. So,
Thank you so much, and it's a brilliant book, so if you recommend it. It's a good place to start. I like the fact that in the book you focus on insurance as an enabler, and I know this kind of the talk of this session was risk, but there is also a lot of opportunity, obviously, in this area. So with that, I'd like to move to Julie and kind of what things as we see in a broking environment, you get to see a lot of what's going on in the market. And could you kind of give us an idea of what the most exciting projects and things we see on a daily basis?
So I'm not in the broking team of climate risk and resilience. There's a broking team and an advisory team, but we do work together. So I would say one of the most exciting projects that I work on at the moment is linked to Article 6 of the Paris Agreement and the voluntary carbon market. So looking at the legal risk and political risk surrounding that. And so that's a very, very interesting area, which Melanie knows a lot about as well. So this is one of the most exciting projects, and also learning still a lot about the industry itself and the different products and services that are there as well.
That's great. What about you, Melanie?
Yeah, I mean, I think I can answer this by just talking briefly about what I'm working on, and then what the team looks at as well in terms of the types of carbon sequestration projects that we review and assess and see whether we can underwrite. So I'm involved in the product development side, where I work quite closely with Chaucer's legal counsel on the development of the policy wordings for our products, other insurers as well. And that's fascinating. That's what really allows me to bring in my legal skills and creativity to marry traditional concepts of insurance with an added nuance, a carbon nuance to them. Our first product, our flagship product, is called Carbon Purchase Protection Cover, and it protects against carbon delivery risk. And so that means it's actually an all risks type of coverage, where with certain exclusions, we can't insure every risk, but essentially it protects against the risk that a forward purchase credit by the insured is not ultimately delivered to the insured due to an underlying non-performance of the carbon sequestration project. And so I think what's really cool and exciting to look at are the types of carbon projects that exist now, and the new methodologies emerging in the carbon removal space. So for instance, we can insure sort of the risks that relate to forestry projects. So that ranges from afforestation to afforestation, planting trees where there were none, to improve forest management, to REDD+ kind of projects. And then biochar, so the conversion of biomass into biochar, which sequesters carbon quite permanently. And enhanced rock weathering, like a rock mineralization, which if you inject CO2 into certain rocks, it produces this sort of substrate that again locks away carbon for a long time. But then there's also, there's also blue carbon, various types of mangrove restoration projects, coastal blue carbon, and then sort of ways to improve the growth of seagrass and all these. And then the sort of the holy grail, which is the technological engineered solutions like direct air capture and storage, carbon capture and storage, bioenergy carbon capture and storage. You can easily get lost in all these methodologies and acronyms and projects. But it is very exciting to see how many companies have emerged in this space, and we'd like to be able to insure all of them, but we're growing progressively. And yeah, I think the state of the voluntary carbon market now is one that is uncertain. It's undergoing a lot, it's evolving, it's fast, it's, you know, a lot of regulatory changes on the horizon, especially interactions with Article 6 of the Paris Agreement. And so we are providing insurance as a way to safeguard some of these investments, because it acts as essentially a stamp of confidence to allow investors to rely on this sort of external validation that insurance brings to convince themselves and their own investors and other market stakeholders to invest in these types of projects. So, but we're not the only sort of market pillar that's needed to enable the voluntary carbon market to grow. I think we also, you know, we work closely with carbon ratings agencies. So these are the Moody's of the carbon world, like P0 Carbon and Silvera, that actually also provide this sort of this investment confidence. We are working to, this is where lawyers come in. We work quite closely to build a product that addresses some of the political uncertainty for some of these, for certain projects located in jurisdictions where the governments are still trying to figure out their interaction with Article 6 of the Paris Agreement and so on. And so it's super fascinating. I could talk about this for a long time, but I'll stop there.
Thank you so much. It is definitely so interesting to hear about, and kind of remind us the role that insurance has had in these kind of big technological shifts through the ages. Like, you know, just thinking back to de-risking things like steam engines back in the day, and now de-risking carbon projects, obviously with the view that, you know, every technology definitely will be needed for the transition. Obviously, of course, it would be great if everything kind of worked according to plan, and there was kind of a global concerted effort in the same direction. But there are challenges. So I wanted to ask you from your three different perspectives as well, what you think the main challenges are in terms of harnessing the potential of insurance in the climate crisis. Who would like to go first?
So having looked at it from a legal perspective, so last year we witnessed the sort of demise of the Net Zero Insurance Alliance. Now it has been replaced by the Forum for Insurance Transition. So there is a problem about working together, obviously, but there's also a problem about doing it alone. And I think the Forum for Insurance Transition, which has replaced Net Zero Insurance Alliance, is a recognition that no insurance company and no insurance broker can do it alone, can go alone. There has to be a sort of a degree of collaboration and information sharing. So striking the right balance there is a tricky issue. Then it's also sort of the shifting regulatory landscape and policies that are related to the speed of the transition. And closely connected with that is that different countries and different regions have different speeds, and global operators like the largest insurance companies, they are often faced with very difficult situations where you have sort of legal landscapes like the EU, which are very advanced and sort of very proactive in what they require of corporate actors generally. And then, in contrast, you have sort of the kind of anti-ESG, sort of legislation in some of the US states. So very, very difficult, landscape to navigate for global, insurers. And then thirdly, I'd say, it's, there's also a problem about, not a problem, but there is a sort of a sensitivity around, shareholder expectations. So, in these of Anglo-American, sort of legal, realm, the sort of prevailing, theory of a company is still that of, that it's there for the purposes of, maximizing shareholder values. And, we know that, Section 172 of the UK Companies Act, has sort of softened that slightly around the edges. But, as of, recent cases like the Shell case shows, at the end of the day, directors, do have a lot of discretion. Their main duty is to, sort of further the interests of the company, and that's sort of regarded as sort of making money for shareholders. So sometimes, it can be difficult for boards to make decisions to go that extra mile and, sort of sustainability, when they're also, accountable to their shareholders.
It would be a very, very real and personal issues there.
Sure, I would say for me, the two main challenges would be, first, I would say lack of funding in some cases where, there might not be, you know, the people might not have enough to, you know, pay for that insurance, but, you know, there's insurers and brokers that come in place and provide certain funds for that, for those specific cases. And another challenge I would say is if you know, certain people in the industry, you know, are convinced that climate change is the biggest issue and that we have to, you know, fight climate change together. I would say the main challenge would be that it's not everyone's priority. So going back to what Francisca was saying as well, it's like it should be everyone's priority. The boards, the shareholders, everyone. So I would say those would be the two main challenges.
I agree with those comments, and I think I'll answer this question just in the context of the carbon market in which we operate, where it is, we certainly, the insurance industry faces challenges entering into the voluntary carbon market, but before that, the VCM, it lacks the underpinnings that are required to enable it to scale. And so what do I mean by that? It's sort of the types of legal, financial, accounting underpinnings that we would traditionally find in other more established commodities markets, that enable the efficient transfer of information and price. And so that includes things like legal interventions, increased regulation on the legal characterization of carbon credits, how to take out security over carbon credits, how to enforce security. And all of this impacts on our ability to insure them as well. And then secondly, it's this is related with I mean, our challenges is the lack of transparency. I think there needs to be an increased effort in the monitoring, reporting, the verification of carbon credits. They have come a long way, but of course, to enable this sort of high integrity markets to develop, there needs to be increased efforts on increasing transparency to enable market actors to come in. And then thirdly, I would say that just increased trust and confidence in general. So I mentioned earlier the carbon ratings agencies that have come up that are acting like the Moody's of the carbon world, And then, that allow for external validation of these types of investments. And then insurance, which comes into play. And I think on the insurance side, we're the early movers in this space, and we have a role to play in educating the market about the opportunities of insurance and getting involved in the carbon markets. And so that's really what we see our role as a PISA, very much the bridge between the world of insurance and the world of carbon. So that's, yeah.
I love that you mentioned trust, because that's often one of the problems as well behind protection gaps and getting increasing insurance penetration in certain jurisdictions. Because there's still that expectation that it will be a public kind of body stepping in under risk. And there's kind of a lack of trust in the ability and willingness of insurance to come in. But I mean, a lot of times, well, that also depends on the people you're dealing with. And one of the things that's often said is that it's a people business. And so if you ultimately, if you trust the people that are there to provide your coverage, to pay your claims, etc., I think that's a good first step. And I mean, I've met some really amazing people in this industry, obviously present company included. So that's mainly what makes me optimistic about it. And did you have any kind of last comments or things you wanted to share before we jump into questions?
To content what you say about it's a people business and that it's about trust, but there are also opportunities in technology and how we can utilize technology, and especially in relation to climate risk, so types of early warning systems. As a kind of example from my family lives in Germany, and they've just introduced this early warning systems where so people get messages on their mobile phone, but they haven't calibrated it yet just right. So there was one day I was visiting my sister, and she must have gotten like 10 text messages about an impending bad weather, front, but then turned out only to be a little bit of a storm, nothing too serious. But what I want to say is that there are lots of ways that we can make good use of technology to build trust, but also to warn and educate and raise awareness. Thank you. We've got some questions online. I don't know if anyone in the room wants to ask some questions first, and then we can do the online ones. We'll bring one in my after. Well, I may as well do the online ones first. So we've got two questions online, not directed specifically at anyone. So the first one is, where is the industry drawing data from to measure value at risk, VAR? Is there one central database, or does it come from a variety of sources? As we're increasingly seeing physical effects of climate change, it doesn't feel as if the data is properly keeping up to adequately measure risk. Anyone?
There is actually a big project going on from EUPA of collecting that kind of data within the EU space, in recognition of the fact that this is too fragmented and it needs to be sort of collected more centrally. In the UK, there's quite a sophisticated system of flood mapping. So I think there are definitely some processes and existing initiatives for collecting data. But one of the issues with climate-related natural catastrophe risk is that so the historic data is only taking us so far. And we are seeing these changes in severity and frequency. So there's also a lot of trust or a lot of emphasis being put on modeling and sort of scenario analysis where you're projecting forward and you're trying to figure out like your worst case scenario kind of impact. So it's not just the data collection, but it's also sort of projecting into the future.
That's a really good point, and you hear so much about different quarters, some say there's too much data, some say it's not enough, some say it's too siloed. And so obviously there's also the issue of data being proprietary, so how do you share it in a manner that is fair to whoever is collecting it and reflects that effort, but at the same time can be used more broadly for everyone's interest. So I think that's one of the like big, maybe unanswered questions that you may have been thinking about, I don't know, but definitely another space where lawyers can get involved, even not insurance lawyers, but IT lawyers or so on.
Yeah, I mean, I think that's very true. This is a great point where, I mean, for us, the lack of, I mean, to build it, to be able to underwrite risks, you typically insurers will rely on historical claims data, but where in sectors that are growing where there are none, you have to rely on other methods. We enter into sort of license agreements with remote sensing technology providers, and as I mentioned, like, so there are these types of companies that exist to monitor the actual real-time performance of the carbon sequestration projects. And as you say, I think it's just not, it is siloed, and it is impeding the growth of this market.
Thank you.
Thank you. And just, we might do one more question online, and then we can hand it to her and then go back online if we need to. Just this question's really interesting, and it's very topical at the minute. It's about insurance associated emissions. So the person's asked how to deal with possible litigation risks from disclosing these emissions. So how do you kind of incentivize these disclosures considering the risks it entails for the insurance industry?
Well, actually, insurance associated emissions are not currently captured by Scope 3. So they're not actually falling within emissions that have to be disclosed. So any insurance company that does do these disclosures, they would do so on a voluntary basis. And in terms of risk, there's the risk that what they disclose is inaccurate. So it's what they disclose has to be also on some kind of evidence-based, also has to have some kind of basis in some kind of scientific evidence. So we can't just pluck out a number.
I guess it's kind of tantamount to advice emissions and the work that's going on there. Probably, I guess it's a slightly different issue to the kind of kickback that we've seen in protests about the kind of companies that insurers insure, and I think that maybe goes more to the kind of other issue that you've identified in terms of how to move away from that whilst retaining shareholder value, whilst retaining client relationships, and how to kind of take a pragmatic approach that's workable, but that actually does also make a difference.
So EC3, the insurance district in London, is frequently visited by activists who sort of suggest that by continuing to insure fossil fuel assets and projects, insurers are complicit in sort of climate change. As far as I know, there hasn't been any litigation yet against insurers directly on the basis that they are sort of contributing. But if you sort of see these general trends and landscapes of the case that has just been started against ING Bank in Netherlands, you can see that there is a trend where eventually it sort of maybe insurers as dependents.
I think if we go to the room then, there should be some microphones moving around. There's a question I think over there first.
I think I'm just, I have a question for Dr. Francisco and Victoria. And I think it's similar to the point that you just mentioned. So first of all, thank you for talking about all these opportunities in the context of, de-risking decarbonization. And I would just like to, unfortunately, go back a little bit on the challenges. And my question is, I'm not talking about litigation, but what do you think are the what do you think are what do you think the regulator is going to enforce on insurance companies who continue to provide coverage for projects that have damaging effects on the environment, biodiversity, or nature in general?
Yeah, no, that's a really good question, and in fact it's a question that has an ongoing debate. So the thinking here is these insurance companies are regulated, and they have to keep regulatory capital, so to make sure that they can pay claims as and when they come in. And frequently, there's questions are raised and say, well, can we not use the tool of regulatory capital to incentivize good green underwriting or green investment and penalize insuring brown? And the Bank of England has been very clear about this and said, for us, regulatory capital is related to risk. So we're not using regulatory capital as a policy tool. Obviously, if there's a risk associated with insuring or investing in brown because it might become a first stranded asset, or there may be other risks, then yes, you have to take it into account, but not just as a question of policy. Now, EIOPA has just finished a consultation on exactly the same question, asking the public and the insurance industry, should we be more flexible in relation to regulatory capital, and should we incentivize green underwriting, green investment? And this consultation came with a report, and in that report, EIOPA was discussing their own research, and it basically said that there is already starting to be research which links green investment and green activities to risk and vice versa, but it's not strong enough evidence yet for it to flow into the capital assessment. But EIOPA was suggesting that it won't be far off in the future that this direct linking between risk and the activities undertaken will become scientifically possible, and then it will be easier for the regulator to make these adjustments in the assessment of regulatory capital.
Okay, thank you.
Thank you all for such a wonderful, clear explanation of such a complicated, gigantic industry. It's really nice to hear. Thank you so much. My question is actually for you, if I may. We're seeing the development of the TCFD into the TNFD, the Task Force on Nature-related financial disclosure, with the underlying problem of how to value nature and biodiversity, which is inherently valueless at one end of the spectrum, or totally invaluable at the other. But the loss is causing gigantic damage financially. Okay, so we've got to find a price for nature, single price for nature in the middle here. And the way that the market is working at the moment is with a plethora of credits in woodland, wetland, peatland, bogs, ponds, hedgerows, soil, carbon, water, diddly, all over, all with different natural capital economics, completely uninvestable. But with insurance losses, particularly in the flood risk, underneath them, floods and droughts, and fantastic damage consequences to corporate supply chains. Okay, we've got a metric here. We've got the known financial damage being caused by these events. Is it not possible to bring together an aggregation of all of these plethora of credits with one particular issuer of the debt who could be responsible for their management, such as local authorities and cities who control the grant of planning consent? They've got no money, they're all in trouble for one way or another. But we've actually just seen the local authority elections and they've suddenly realised they've got real power. Okay, if local authorities were to issue a green bond for their region, like Cambridge, which is science capital of Europe, suppose, with another 150,000 homes to be built on a floodplain, with an insurance risk that's known, could not Cambridge issue a green bond for Cambridge based on the insurance value of the assets at risk of flooding, which will be mitigated by their control over the woodland, the wetlands, the bogs, the ponds, the mires, the farmers and the landowners who need planning consent for a change of land use? My question, it's a long way into the question, is will the insurance be covering the underlying projects or the creditworthiness of the issuer of a green bond, like Cambridge County Council? Which way would you prefer it to run?
I think just to take a step back, that's a fascinating scenario. I need to think about it. But when you were talking, I did think about what has been brought already is in existence for a number of years in Scotland and has now been brought by the Climate Change Act, I think. The idea of conservation easements, conservation covenants, right? Where the project developer contracts with the local authority to implement a sort of covenant on the land where the biodiversity or the carbon removal project is taking place, whether it's forestry or peatland conservation, for a number of years, you know, for to enable the project to continue in perpetuity and reduce the risk that the planning consent, that the planning permission changes and all of a sudden what used to be a forestry project is now a construction site. So that's, and so the insurance there, I think would fit quite nicely with either the project developer, so to insure against the unforeseen, unavoidable kind of losses that would arise from the implementation of these projects. And it would have to be a sort of it wouldn't have to be a policy that gets renewed after a set number of years. But I want to think more about your question, and we'll get back to you on that. Yeah, it's not something I've thought of before.
Because it would be a single point. legal liability on the local authority, like Cambridge. Cambridge is a key model here. Big strategic investment for the UK.
Well, okay, so what is also being put into place is the development in the UK of carbon standard programs. So and that essentially act as the overseer of the carbon projects that get developed under their methodology, and that those projects are themselves being governed and implemented by local council, by trusts, by that are owned by the local authorities. And that brings into play the question of who will actually ultimately manage a central pool of credits that are set aside to protect the integrity of the scheme as a whole. And that's the sort of what the buffer, what they call the buffer pool of credits. And actually at PISA, we're developing a product to enhance the protection afforded by this buffer pool of credits and enable and so the reason why this exists is to protect against unforeseen losses, forestry fires and so on, that would require the carbon standard to compensate for those losses by drawing upon the buffer pool. And so, yeah, we're looking at this angle. But so in the UK, especially, there are I think, as you say, opportunities to work with local council on these types of projects. For sure, we're doing that currently.
I think we have time for one more very quick question, and then just we have a break for the creative content. So if you can keep it quick, that would be great. Thank you. Yeah, just one question.
Hello, Ben Brewster. Thank you everyone for your contribution. So I just wondered if you had any thoughts on this. So in rich countries, we now have this very convenient situation where within the energy sector, it's usually cheaper to build renewables than fossil assets. But in poorer countries, because of the high upfront cost of renewables, and because of the higher cost of finance, actually in a lot of cases, it's cheaper to build fossil projects. So that seems to me all about risk, country risk, regulatory, political. I just wondered if you had any thoughts on what law and insurance might be able to do in that area, because otherwise it's going to slow down the transition in large parts of the globe.
That is a good question.
No, I mean, the immediate thought that comes to mind to me is political, and I think that's what's needed in those kind of respects is some kind of concerted decision about what kind of financing is going to be directed to those projects, which kind of entities are involved, which kind of investors. It's tricky also because I'm not very familiar with the sort of panorama or kind of insurance in certain sort of less developed areas. I don't know if you
Michelle, you were showing earlier the Sustainable Development Goals, the 17 Sustainable Development Goals, and I think this is another sort of area of not conflict but potential barrier. That's often the Sustainable Development Goals, they can conflict. Climate change and fighting climate change is only one of them. And the same with ESG, sometimes the S and the E are in direct conflict as we've seen in relation to energy policy. So I think it's a political issue, but it's definitely something that where it's an example of where that climate change does not always take the top priority, and that there are other considerations.
Yeah, I mean, it's true. I think the question you were asked in the podcast, 2 weeks ago, was, those insurers just insure everything that's presented to them, isn't that kind of their role to be neutral and whatever they take? But that's not really necessarily true, because what they insure needs to make sense commercially as well. And so like, if the risks of, especially like stranded assets are high enough, that's certainly a consideration that can be made, and there's metrics probably to assess or to measure the kind of lifetime that a certain sort of energy plant can have, and then work from there. But yeah, ultimately someone needs to decide to do that.
I think that's probably a good place to end. Thank you so much to Lucia and to you guys. I think we'll give them a big round of applause. Yeah, thank you. It was super interesting. I suddenly worked in insurance. I learned a lot. So I'm sure everyone would have picked up on new things. We're going to move to the creative content. We'll just have a quick break, so just a few minutes if everyone wants to go to the bathroom or anything. And then when we come back, we'll go into the groups and have a look at the video that Lucia's chosen for the creative content.
And thank you, Kat, for doing an amazing job, and the whole LVF team. So it's been really great.
And just for those online, we'll split you out into breakout groups so that you can speak much of that was for the creative content as we've shown that on the screen.
When are we starting off?
Not speaking at the same
Thanks, everyone. So we're just going to play a video which Lucia has picked to kind of counteract some of the negative, serious thoughts and things that people say about the climate crisis. So this is kind of a lighthearted take of the climate crisis. So we'll just show the video, and then we'll break out everyone online into breakout rooms. And then if everyone in the room here can arrange themselves into groups, and then we'll get the facilitators to facilitate the discussion.
Our planet is changing, and not in a good way, like into a butterfly or a giant magic shoe. And we're all to blame. I'm talking about climate change. 19 centuries ago, there was an industrial revolution which used coals. Coals is a fossil fuel, which means setting fire to dinosaurs. It's this dirty dinosaur gas which has been blamed for climate change. What's more, so many dinosaurs were burned for steam trains that nowadays there's almost no dinosaurs left. Rising temperatures are a worldwide problem. Experts say they're responsible for making the North Poles melt, meaning too much sea. Not everyone wants to live in the sea. You don't have to be a scientist to know that. You just have to have seen The Little Mermaid. She hated it. The government says we need to cut our greenhouse gas emissions by 2050. But if, like me, you don't have a greenhouse, they say you can reduce your carbon footprint by not flying and walking more. But my feet swell up when I walk, which is why I came here in a car. Storms battering the coast, tornadoes, blizzards, rain, women in bikinis, floods. If we keep discussing climate change at such an alarming rate, scientists predict the world's stock of weather footage will be exhausted by 2050. But not everyone thinks climate change is real. This hot topic has split the science community straight down the middle, 90-10. To hear both sides of this debate once and for all, I found one climate expert. Good afternoon, what are you?
My name's Andy Watson. I'm a marine, atmospheric and climate scientist.
How does weather actually work? And if you could make it snappy, because it's going to be on iPlayer.
Well, the atmosphere is constantly in motion, This motion means that you get winds if the air is rising.
Yeah, I'm going to need you to be a bit more snappy.
You get rain, you get snow.
Snappy. In one word.
Energy.
Energy, yeah. The world's getting hotter, isn't it? But how can we stop ourselves from turning into steam? What do we do? Should we just start eating more salad and stuff like that?
It's certainly true. We will have to adapt to a warmer climate. And we will probably have to eat different things. Because
Ice cream and stuff.
well, certainly as the world gets warmer, you know.
Probably going to be an ice ban though, isn't it? So we can't have ice lollies.
I don't think so. It's not that bad.
How hot is too hot? You know, I mean, will we be like going, ow, all the time?
If global warming happens really slowly, then the world could probably adapt to being quite a lot warmer than it is
And we'll be
today.
long gone by then, so
Well, that's true, but you've got to think about, you know, our children and our children's
I'm
children.
not going to have kids, I don't think.
Well, some people
Yes,
do
some
want to
people
have
will.
children.
Yeah, but not until like their children's children, so we don't sort of care, do we, about that?
Well,
There's a difference between thinking climate change is man-made and thinking climate change is made up. But I can't remember it because I'm too hot. And that might be a warning to us all, a global warning. Next time on Moments of Wonder.
Okay, thanks everyone. I hope you enjoyed that. Now everyone in the room can just split up into groups. Your facilitators have badges on. Just get yourselves into groups and then you can kind of discuss the creative content. And for those online, we will split you up into group breakout rooms.
Facilitators stand up and sort of identify yourself, and you can gravitate towards.
How many? Yeah, Yes.
Yeah.
carbon law, are they very significant? I don't know if we want to start with online, Sarah, or maybe if you want to kind of talk about what you talked in your group, how the video made you feel, that kind of thing.
Yeah, sure. So it was a pretty wide ranging conversation. And I think, I mean, personally, I didn't quite like Philomena Kunk's brand of humor. But I think several of the participants said they quite enjoyed the use of humor in almost making quite an uncomfortable topic more palatable and getting it onto a broader audience's front of mind. I think it possibly wasn't entirely directed towards us. Rather, it's probably directed towards, yeah, a broader audience. Sarah, do you want to jump in on anything?
No, I think you've captured the discussion about the creative content quite well, but we had some interesting questions from Viviana about the role of insurance and the inherent conflict in insurance companies and the way they operate, and the different segments of insurance companies often doing things that to an outsider seem very, very contradictory. So we didn't come up with a conclusion or reach anything definitive in that respect, but it was an interesting point that was picked up.
Yeah, that was definitely interesting. I think everyone who works in insurance probably has come across that contradiction. If we want to start over on this group over here, does someone want to stand up and say what you discussed?
Oh, no, it's okay. Cool, thanks very much. So quite similar to what's already been covered in terms of the online groups, we had some different perspectives on the humor. I thought at the beginning it was quite refreshing. Humor is not something that we often see in the climate space, really because there is no time and we're so pressured to act quickly and the risk is so large that we kind of forget to have a laugh along the way. So there's the positive, but there's also the negative, and that even though this video is quite old, I think it was mentioned it's about 9 years old, it still felt very relevant that people still hold these viewpoints. And then in fact, we make the point that there are very powerful people like Donald Trump, who say these things seriously and people listen. So it was also at the same time incredibly terrifying. And yes, that was just on the content as well. We had some good discussions about carbon credits too. That's it from this group. Say hi, Dave Burton, this week.
So we also started off by talking about the use of humor, sort of saying that it depends on the audience. So maybe if you have an audience who's already worried about climate change, then these types of jokes might work and it can be a way to start the discussion. But maybe it's not the best way of introducing the topic and making people take it seriously if they're not already concerned. And then we also talked about our different jobs and how we might work with educating people about climate change and talking to people about climate change. So what we essentially did was that we talked about if we like the video and the overall sentiment that we would in this group at least. And then we narrowed down the ideas to 3 I's. So we talked about first insurance, of course, then inaction, which was also a big topic. So who is doing what and who is not doing anything. And also the sentiment of ignorance for the video and how, as other groups have said, people still find themselves talking that way and not really doing anything. And for last, not an I, but a responsibility, who is accountable for doing something and that we all should contribute to doing something about it.
We appreciated the levity from the humour. That reasonably funny. But we had some of the discussions about kind of the audience, and we also thought, potentially, it may not have aged well, even though it was kind of 9 years ago. We've already seen so many climate events that have already happened, so we're not even really talking about future generations. And also an interesting point about being kind of in a post-truth era where there's lots of misinformation going around and, you know, perhaps this video may, you know, be contributing to misinformation or not, you know, people won't be able to consume it in a way that's satirical, and kind of clearing that. So that was, yeah, some really interesting conversations we had. Oh.
That's great. Thank you so much, everyone. It's really, really interesting to hear what you think. It sounds like there were kind of different reactions. Some people find it funny, some people find it not so funny. So yeah, really, really great to hear that. Thank you everyone for coming. This is the end of the session now. We've got, as we said, we've got a pub booked. So please join us afterwards at All Bar One. But I just want to say again a massive thank you to Lucia for the presentation and to our speakers, Judy, Melanie, and Dr. Arnold Dwyer. It was such an interesting discussion and just so interesting to hear their insight. And yeah, I think we probably all learned a lot. So can we just give them another round of applause? And just to say thank you again to the Grantham Research Institute and LSE and Emily, who's been such a massive help, and to all of our facilitators as well.
Oh, thanks to you.
Yeah, so if everyone wants to make their way to the pub, sorry for those online if you can't join, but hopefully, we have a nice evening. Bye.